Welcome back. We're doing Discovery. Discovery includes things like the Discovery Channel, obviously, HGTV, the Food Network, TLC, Animal Planet. Those are some of their top channels. So the company's been making recent news because they have a merger coming up with AT&T's Warner Media section. And I touched on that a little bit in the AT&T stock video, but I wanted to do a full valuation on Discovery because it's recently been gathering some momentum. So look at this. I have a 1-week chart, and just on Friday, it went up 19% in one day. It climbed from $25 a share all the way almost to $30 a share. That's incredible. But what makes that even more appealing is that if you look at the 1-year chart, they had this huge fall back in March last year. And the reason is that they were also one of the stocks wrapped up in the Archegos Capital collapse. I talked about that story in my Viacom video, so I'm not going to rehash that. But the reason I'm saying this is because even though they just had a plus 18% day, I don't think the boat's left, if that makes sense. I think there's still room to grow. So the big news that came out recently was that Bank of America upgraded them, and there's a news article here about it, I think, right here. Upgraded to buy by Bank of America. I think they upgraded their price target to something like $45 a share, which would be 50% upside, right? I mean, look up here in the calculator. 45 divided by 30 is 1.5, so 50% upside. So what we're going to do, take a deep dive into the financials, see if we can come up with a valuation of our own, and see if it's a company we'd like to buy. Let's get started. Income statement first, as always. And the first thing of the income statement is the total revenue. So we always like to look at this, make sure it's growing. Definitely growing. Look, this data goes back. This is every quarterly report going back to March 2009. I just get this data from Yahoo Finance, and they have about tripled in the last 10 years or so. So from $1 billion of revenue a quarter to over $3 billion. Awesome. We don't get any valuation from that. I just always like to look at that, and you should always look at that too. It's super easy. All right, next up, operating margin. So this is the company's operating income divided by the total revenue. This is not good. I don't like seeing this at all. Their margins are really shrinking. So even though their revenue was growing, I'm worried that we're going to see pretty flat earnings because of this margin. And in general, shrinking margins are never good. Shrinking margins means that you're losing some kind of competitive advantage, that you're not able to charge a premium for your products compared to what you used to. So remember, I look at margin in 3 different ways, right? I look at on an absolute basis. So in that case, I like to see over 20%. I look at relative to competitors in the industry, and I don't have that data right now, but that would be easy to go find. And then I also like to look at relative to its previous history, and that it gets a F on as far as relative to previous history. The margins have almost been cut in a third in like 5 years. That's not good. That's scary. But stocks are all about income, right? If the income goes up, if earnings go up, the stock's going to go up. That's what Peter Lynch always says, right? And he's right. Okay, before I do that though, real quick, we're going to look at interest over operating income. So this gives us a great way to measure how much the company is relying on debt to make money. So this is not good at all. So this is saying of their operating income, on average 33%, around like 30% is going straight to interest payments on debt. That makes me sick. That's worse than a second tax. The corporate tax rate's 21%. So your operating income, you're just dishing out a bunch of it to debt collectors as interest. It's not even paying down debt. It's just interest. Ugh. Big red flag for me. Got to be honest. All right, let's go to pre-tax income. Let's see if how much it's affecting their income. Yeah, this is not great. So even though their revenue was just growing over the last couple of years, their income has actually shrunk a little bit. So down from $600 million a quarter to almost $200 million a quarter. And, I think we saw the reason why. Lower margins, higher interest as a percentage of the operating income. Definitely not a great sign. So to get a number here, I'm going to take an average of the last 3 years. And this is quarters, so I'm going to take the average of the last 12 quarters, and that is $480 million per quarter. So to get that in a yearly number, I'm going to do 480 times 4, and I get $1.9 billion on a pre-tax basis. I'm putting that in the outline section, $1.9 billion. All right, growth rate, I'm putting 0. I don't care that their revenue's growing. To me, that's offset by their shrinking margins, and I'm trying to be harsh here because, look, Bank of America upgraded them to 45, so that's 50% upside. I'm going into this stock with the idea that I might want to buy it, so because I'm thinking that way, I always want to take very conservative assumptions, because if you're optimistic in the stock valuation, you're going to wind up making your decision before you even go through the exercise, because you're subconsciously going to want to take optimistic assumptions, and then you're more likely to lose money that way. All right, so like I said, 0% growth. I'm being extremely harsh here, but that's because I'm looking at it as a buying opportunity, maybe. All right, let's go to earnings per share. So it looks very similar to the pre-tax income. I'm going to take an average of like the last 2 years, so the last 8 quarters here. All right, the average is 50 cents a quarter. Actually, it's 49 cents. So 49 cents times 4, that's $1.96 on average for earnings per share. All right, now let's go to the balance sheet. All right, first up, total assets. You can see here there was some big jump. That's probably an acquisition. That's usually what it is. What I like to do here is get a pre-tax return on assets. I always talk about it, but it's a very intuitive way to judge a business, right? So what I'm going to do is take that pre-tax income that we got in the income statement, so 1.9 billion, and divide by the most recent total assets. So divide by 35. So 1.9 divided by 35. And I get 5% return on assets on a pre-tax basis. Pretty low. I want to show you something though here because I usually do return on tangible assets. I think that's more valuable and I just want to go through that. So if I take their goodwill, so keep this in mind, they have $35 billion of total assets. So let's look at goodwill. Where is it? Where's goodwill? Goodwill. Okay. Look how much goodwill they have. Close to 25 billion. So they had 35 billion of total assets and 25 billion of that is goodwill and intangible assets. That's a lot. So now I'm going to look at total tangible assets instead of just total assets and see that that number is actually like 10.9, so $11 billion of total tangible assets. And now I'm going to get a pre-tax return on tangible assets. So 1.9, same calculation, but this time we're going to divide by 11 instead of 35. And I get 17%. Much higher, so they're doing well on tangible assets. It's just whenever you factor in all their intangible assets that they're carrying and goodwill, those aren't really making them any money, and it makes sense, right? It's hard to make money off of goodwill, right? Those are not usually income producing assets. All right, well anyway, let's go to total liabilities. That's next. I'm gonna write this down because I want to use it in the cash flow section for a new little metric I'm gonna show you. Okay, so all I'm getting is their most recent total liabilities. So the most recent one is $21 billion. So I'm just going to write that down, $21 billion. I'm not interested in anything else here. I'm just saving that value for later. All right, next, total shares, all right? So this is going to tell us, are they diluting or are they buying back shares? All right, so they have been diluting shares. And I think this might line up a little bit with the acquisition. In general, if a company wants to buy new assets, there's a couple ways to go about it, right? They can either go into debt to do it, they can pay cash, or they can issue more shares to raise equity to buy the assets. It looks like in this case, they're definitely in favor of issuing new shares. That's dilution. That's not always terrible, but if you gave me the choice between diluting shares and company buying back shares, I'd take buying back shares every day. So kind of a little bit of a red flag for me. All right, next we're going to look at equity per share. Where is it? Stockholders equity per share. And we're going to use this to get a price to book ratio. But real quick, look at this. This is growing. This is actually pretty good. So you always want to look at equity per share for a company because this is kind of like a net worth, right? So it'd be like if a company sold all of its assets, paid off all of its liabilities, and then divided the leftovers amongst all the shareholders. So like I said, it's a net worth calculation. So to see it rising is actually really good. I'm actually surprised to see this because earnings were decreasing and they're diluting shares. So this is actually like a huge positive. I'm very surprised to see this, and I think it's a great sign for the company. So look at this growth. So they're at like $23 a share now, equity per share. And then 5 years ago, they were like at 15. So if I take that growth rate, 23 divided by 15, raise that to the 1/5 to get an annualized growth rate, I get a growth rate of 9%, 8.9%. So that's stronger than the 0 I put. So I think I was a little harsh there. I'm going to cut them a little bit of slack and I'm going to change my growth rate to 2%. I really, really like seeing this equity per share growing. This is a huge plus for me. Great. That's a huge change of tone for this. Oh, I need to get a price to book. Okay, so price to book, I take the current share price, $30 per share, and I divide by 23, and I get a PB of 1.3. Pretty strong, pretty strong. All right. Awesome. Let's go to the cash flow statement. All right, free cash flows first. So what I'm doing, first off, making sure it's growing. That's great. So this is actually really good too. The tide's starting to turn a little bit. So even though their pre-tax income and their earnings per share were both shrinking, their free cash flow is growing. So this is awesome. Wow. All right, I'm going to do like I did for earnings and just take an average of the last 8 quarters. 2 years, 8 quarters. And whenever I do that, I get a average free cash flow per quarter of $639 million. So 639 times 4 to get a yearly number, $2.55 billion. Wow. So I'm going to round up 2.6. $2.6 billion for free cash flow on a yearly basis. That's significantly higher than our pre-tax income. So now I want to see what's going on. Why is that higher? It's a good thing. I'd always like more free cash flow than income. Cash is king, right? But I always want to know why, because I'm suspicious. All right, so I'm going to look at depreciation versus CapEx. So if you look, they're depreciating, and this is what's getting minused on their income statement, $1 billion to $1.5 billion a quarter. That's almost what their pre-tax income is on a yearly basis. Wow. So they have huge depreciation. They're depreciating in one quarter almost what they're making in income in the whole year. That's crazy. Ugh. All right, let's go to CapEx then. So I assume this is going to be really low. All right, it is. Oh, what? 100 million, that's it. So almost a tenth of your depreciation. That confuses me. I've never seen a discrepancy like that. And even if the rest of this video goes perfect for them, I'm going to be looking into this further to try to understand it, because it's definitely a head scratcher. It's great. I mean, they're generating a lot more cash, but I want to know why. Is this CapEx going to have to increase a lot more in the future? I've talked about this before, but I get scared, especially with manufacturing companies. This is not a manufacturing company, so that's why I'm less scared. But let's say that you had a manufacturing company with a lot of equipment and their CapEx was way lower than their depreciation. To me, that would tell me that they're deferring a lot of maintenance. They're kind of kicking the can down the road, and at some point they're going to have to invest a lot of cash to keep up with their assets. But like I said, Discovery, not a manufacturing company. They're not producing anything. They're more of a media company. Like I said, I'm confused but optimistic. I'm going to look into this further. Not in this video though. All right, let's go to, I need to do my liabilities per free cash flow. Okay, so this is a good metric, and I see other channels do this. I think Everything Money does something similar as one of their pillars. So you just take the total liabilities, you divide by the free cash flow, and it gives you like how many years would it take you to pay off all your liabilities based on your current free cash flow. So total liabilities was 21 billion divided by 2.6. So here I get 8. So it would take 8 years of free cash flow to pay off all their liabilities. That's pretty high. I knew that was going to be high just because if you remember in the income statement, our interest per operating income was super high. So the company's got a lot of debt. They're relying a lot on debt to make money, to generate cash. I personally really don't like that. And I don't like a liability to free cash flow ratio like over 4. That's kind of my cutoff. I mean, I like it as low as possible. If it's 2 to 3 years, that's even better. But, 4 is okay. All right, but anyway, let's go to valuation. Let's wrap this up. All right, pre-tax income times 10 divided by the number of shares. It's just my rule of thumb method, 1.9 times 10 divided by 0.505 because it's million. All right, $37 a share, 38, I'm gonna round up, 38. All right, is that higher than, yep, that's higher than the current share price. That's like, let's see, how much higher is that divided by 30? That's 25% higher. Pretty good, pretty good. All right. Next, we're going to do our earnings per share method. So $1.96 times 8.5 plus 2 times our growth, which is 2. And I get a price target of $25 a share. So, all right. And then lastly, our discounted cash flow model. Basically, we just put our free cash flow number and then discount it at a harsh 15% until the DCF plateaus kind of, and you'll see what I'm talking about. So 2.6 billion is our free cash flow, our perpetual growth rate. I'm going to say 2%, and then our discount rate is also required rate of return is 15%. And you can see here, the way the discounted cash flow works is even though we're going out 100 years, the graph really stops moving after about 15 years. So it really plateaus. All right, so net present value I get for the market cap of $23 billion. Pretty strong. All right, 23 divided by 0.505, and I get $45.5 a share. So $46 a share. Hey, that's Bank of America's number. Interesting. Why is my average not working? Hold up. All right, my average is back. Average price target, $36 a share. That's 20% upside. That's pretty strong. This is one that's definitely piqued my curiosity. There's some questions I still want to answer for myself. The only thing I really don't like, well, there's 2 things I don't like. I don't like the shrinking margins and I don't like the high debt, but it's obviously still selling at a discount. I think if you were able to buy this, in the low 20s like some people did, that was a great purchase and congrats on finding it then. Like I said though, that this is one I'm gonna be looking into more, but that's just me. A part of me wants to own them too just because this was like my childhood, right? Mythbusters, Dirty Jobs, Man vs. Wild. And if you don't know what the quote up top's from, I got a link in the description if you want to take a trip down memory lane if you're even close to my generation. I wanted to make that my outro song, but I didn't want to run into any copyright issues, so Like and subscribe. I'll see you next time.